Brian, let's talk about donating appreciated non-qualified property. First of all, what is non-qualified property?
Yeah, basically that's property that's not in a retirement account, a IRA type of account. So property that's not in that has gains to pay tax on. So really what we're talking about is, let's say that you have appreciated stock in some kind of common stock like Microsoft, or you have appreciated real estate. Those are the two primary vehicles we use if we want to donate appreciated property to a charity.
Brian, how does the tax situation come into play with this?
Yeah, the reason we're talking about this is because a lot of people want to give money to a charity, but everybody likes a tax advantage. Pretty much everybody would like that. And they want to do good for their charity and give as much as they can. But sometimes taxes can get in the way of that. So this is used in an example where you have a charitable intent, you want to give money to the charity, and you look at your assets and you go, I really don't want to give my cash if I can get a better advantage by giving something else. And then you look at your assets and say, well, I do have this stock that I'm never going to need, because one of the detriments to doing this kind of thing is that you don't have the money anymore. You gave it away to a charity. That can be a good thing, but it also took money out of your accounts. But if you have some stock, you say, I'm never really going to need all of this money that's in my stock account. Or you have some real estate, again, as I mentioned, and you want to give that, you can give those away instead of your cash.
So Brian, what are some of the other advantages to using this strategy?
Yeah, well, one of the advantages is that if you were planning on selling that asset, you were going to have to pay taxes on it. Well, when you give it directly, you don't pay income tax on the gains of your stock or real estate. When the charity receives it and they sell that asset, they don't pay any income tax on the sale of that asset. Had you sold that asset, let's go back to that example, let's say you sold it, you paid the tax, well, your taxable income's higher, and now that might be popping you into a higher income tax bracket. Sometimes when you're in a higher income tax bracket, you're going to pay higher Social Security costs, Medicare costs, or have higher amounts of your Social Security taxed for income tax purposes. And finally, if you sell an asset and pay the tax and give that money to the charity that's left, your tax deduction on your itemized deduction form is lower. So there's a lot of advantages to giving the asset directly, income tax advantages. I think I named about 4 of them there. Your tax deduction, the fact that you're not paying tax on it, they're not paying tax on it, it doesn't affect your other income and phase outs and all these other things that can occur by giving that asset directly instead of cash.
Do you have an example of a client that you've helped using this strategy?
Yeah, you look at the example of somebody that has 100,000, 2 different people have 100,000 of Microsoft stock, and one of them sells it, maybe pays 20,000 in tax, since they got $80,000, and again, that popped them up maybe to a higher bracket. Their Medicare premiums and so forth went up that next year. More of their Social Security was taxed. They didn't like that on their tax return. They gave the charity 80 grand, and they took the $80,000 deduction on their tax return. Conversely, someone else, listen to this video, gave the stock directly, got a $100,000 deduction, didn't pay any income tax. The charity benefited more because no one paid the tax. Instead of getting 80, they got 100. So same example, same stock, 2 different people. One had a whole bunch of negative attributes, and the other one got to benefit their charity even more than they could have having sold that stock and given them what's left.
Interesting strategies, Brian. Thanks for telling us more about these gifting strategies.
You're welcome.